Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week up, Goldman Sachs. Let's take a look at this bank. What are they? Are they a traditional bank? Are they an investment bank? What do they do? How do they make their money? And how much is the stock worth? Let's go through this report. This is the 2020 annual report filed December 31st, 2020. We're going to take a look at their net income, revenue, how they derive their revenue, and where we think the stock can go. Ready? Let's get to work. So before we look at the stock, let's review the three key attributes we're using for all of the bank stocks we're doing here in this series. Top line revenue growth, you got to have it. Earnings growth, net income needs to be growing, and book value per share needs to be at a reasonable price we're going to pay so that the economic return that we get by holding the stock over a decade beats the stock market. That's what we're looking to do. All right, I want to outperform. So we value these companies to find the cash flow, figure out how much they're going to be worth, and on a conservative basis, what do you think we can earn? And we wait for the price to come to us. We don't reach for an expensive stock. Okay, before we dive into the numbers, I want to point out a couple things in the 10K. You should definitely always read the annual reports. They are hard black and white figures that are very, very interesting, and they disclose all kinds of material. But what I want to point to you here is net revenues. Where does Goldman Sachs derive its revenue? Is it a traditional bank that's taking in loans, issuing bonds? Is it a investment institution like a Morgan Stanley or a Merrill Lynch? Let's figure out. So net revenues, 2020, investment banking, $9 billion, right? So if their total net revenue is 44, you got $9 billion, it's a big chunk, is their investment banking division. Investment management, $7 billion. The big one here is market making, $16 billion of the 44 is market making. The rest of it, other principal transactions, commissions and fees, basically the non-banking business is $40 billion of the 44, so largely non-bank. But Goldman Sachs filed to become a bank many years ago because they wanted access to the Fed window and some other things, probably wanted to expand their business model, fine. Because a lot of this transaction stuff is one time, is once it's done, they have to go find another customer, another client to repeat that same business. It doesn't scale very well, whereas banking does scale. Margins are lower, but once you're at a bank, you very rarely change banks. As a result, that sticky money gets a little higher value. So I think that's why they did it. Their net interest income, which is like bank revenue for them from lending out the deposits they get, $4.7 billion, up from $3.7. So that business is growing. The institutional bank business is growing. Overall, they're growing, but their traditional banking business that we would think of as a bank is relatively small. So we're going to keep that in mind, that this institution is largely investment banking and capital markets, which, by the way, I know several people at Goldman Sachs, super bright people. If you ever wanted to do a capital markets transaction, reach out to me. I'm happy to make an introduction. They can solve all kinds of problems. Really quite amazing institution. Let's take a look long term at their financial data. So what I'm going to do is I'm going to value Goldman Sachs as I would a traditional bank, and then we're going to adjust how we look at the price right before we do the IRR calculation to account for most of their business coming from non-banking entities. But we're going to follow the pattern we have been. So assets $938 billion to $1.1 trillion. So assets are growing at 2.7%. Fantastic. We want to see top line, rather asset-based growth. Then what we're going to do is we're going to subtract net income, goodwill and intangibles, as well as total liabilities and preferred stock from assets to get a net book value. Book value is what you're buying when you buy common stock of a bank. You want this number growing. And good news, it is $64 billion to $81 billion over this time frame. Pretty steady, kind of clicking along, 3% a year. Nothing crazy. I mean, it's a big bank, but it's still growing, which is nice to see. Then I've got book value per share here also growing. And then capital, market cap, shares outstanding times price, and a book value. Book value is how we do book value per share. It's how you look at a bank, right? How much in price are you paying for the value you're getting? That's basically market cap divided by book value gives me this ratio. And what you can see is historically you could buy for almost 1 time. That's many, many years ago. And it's gone up and then kind of come back down. I think the COVID crisis has kind of pulled them down a little bit. They're at 1.2 times value. We'll figure out if this is a good market multiple or not, but on average, 1.2 seems to be about where this bank trades. So we'll figure out if that's a discount or not. Let's take a look at revenue and net income. So here's where it starts getting interesting because you've got most of their revenue and net income come from non-bank sectors. So let's see how they're doing. $34 billion to $41 billion. So over this time frame, they've grown their business. It looks like here's kind of flat, 34 billion. Then it drops to here, drops a little bit, and then kind of comes back. I did note, however, that in the disclosure, they say that in 2020, because of COVID, there's a $3 billion of credit loss that I've adjusted these two numbers by that $3 billion. And it says that there was basically a $2 billion year-over-year change. So they had $1 billion write down in 2019, $4 billion in 2020, a $2 billion delta, $1 billion to $3 billion actually, excuse me. So what I can do is I can take that $2 billion year-over-year increase, I can add that back to this 9, which gives me basically 11, just shy of 11 billion, which is considerable growth. So I think they are growing their net income. This average here, 2.6, is too low because this number is too low. When I adjust it, I get 3.7. That even might be low. If looking at some of these numbers, certainly depending upon when you pick your target, if you pick this low point and come to here, you'll be at a higher than 3.7. I'm using kind of an average of these years and an average of these years to give me a rough ballpark, and that's about 3.74% annually on the net income growth. But what are they doing with that cash, right? One of the things they're doing with this money is they are buying back stock. And this is something we're seeing from all the banks. All the banks are buying back their shares. I think that's indicative of the banks themselves saying that they are undervalued. 500 million shares outstanding to 360. That's 360 million shares outstanding. That's 140 million shares that they have retired. I think that's about 20%, 25% of the outstanding shares at this time have been removed over this period of time. 4.4% annualized reduction in shares without you having to put another dime in the business. That's pretty nice. Earnings yield 8.5%. I'm excluding this 11. That's a little too high, but that's a higher yield than we've seen in past bank stocks. And I think that might be because most of their revenue is transaction based. And that means they have to go out and get new business every single time. Right now, with the capital markets as robust as they are, lots of companies are IPOing. Lots of companies are buying stocks, doing mergers, issuing debt. The transactions in the market, the financial markets, are really high. And these guys participate in that. In fact, most of their business is transaction-based. Well, if the economy cools, those transactions are going to cool. I would expect revenue to come down. As a result, I think they're trading at a higher yield because people are not giving them, they're not paying the premium that they would for if that was really recurring business, like a bank that's a bit stickier. So you're seeing a slightly higher than average yield in that case. But let's go forward and let's forecast and figure out what we think this business is worth. So if I take a look at book value as a traditional bank, how would we value this business? Well, I take the book value that they have. I look at their historical growth rate. I'd say, they've been growing book value for 3% a year. I'm going to continue that 3% growth out over time. And if I do that over the decade, I get $110 billion of net book value. I apply a 1.2 times price to book value ratio, which is their historical ratio, and I get a market cap for the stock. If I divide by the number of shares outstanding, I get a price of $370 per share long-term value based on the book value approach. So if we forecast on net income, what we're going to do is I'm going to take the average of the last couple of years. Because COVID was a down year, I'm going to take the average of the last 3 years on a per share basis. And I'm going to apply our net income growth to that. So this $23 share is the average per share income the last several years. I'm going to grow that at 3.7% over time, and I get just a little over $32 a share. I apply a 8.5% yield to that based on the average that they've been yielding, and I get $384 long-term price for Goldman Sachs. Now, if I look into the stock market, I can buy all the stock I want at $415 a share. I've got two price estimates, one based on a net income yield of $384. Another one based on a market multiple, a book value approach. at $370, very close to one another. But I am going to do something different. I'm going to weight the net income yield 75-25 because most of their income is on fees and banking. And what I want to do is I want to make sure that I'm not too much relying on book value, because I don't believe this stock is truly valued on book value basis, because so little of their revenue is actually derived from the banking aspect of their business. Most of it's transaction based, which is easier to measure on a net income yield basis. So I'm giving it a 75% rating. All in all, these numbers are so close, it doesn't make that big of a difference. And I get $381 a share. So if I go out in the market, I buy the stock for $415, I get my income that I'm going to get over time. And I can sell the stock in the future for $381 is our price estimate. And I've assumed that I dividend all the net income out. I'm basically getting the net income yield of the stock over time with a small loss in capital over time, which gives me a 7% IRR. So for us, this is wildly mediocre. And I think what you're seeing is a stock that's fully reflecting a premium of the price being paid for all the transaction activity that's going on in the capital markets right now. People are paying up for those earnings, but over time, as the capital markets wane or the book value grows and it kind of reverts back to an average, I think you're going to see a lower stock price, assuming that they dividend all the stock back, all the cash out. Right? Realistically, they're going to continue buying back shares, so it's going to be more difficult on a share basis to see that. But overall, I don't think the business had a lot of upside. Let's recap our 3 criteria for banks. Revenue, top line revenue growth, it's there. Earnings growth, it's there. Both those check the box. Well priced, I don't think it is. I think a price per book ratio is too high for what this is yielding. And what's turning out is it's showing a sub IRR, a sub-market return IRR. So for me, it's a meh. I like the stock. I certainly like the people who work there, super bright, but I would wait for the stock to come down before you buy it. Let's take a look at the matrix and see where does the stock need to be really interesting. At 415 is a 7% IRR, assuming all these numbers pan out. If it increases, obviously it gets less. But if the stock falls, and it falls in around a $300 range, that's where it starts getting really attractive to me. Because otherwise, I think there's too much risk here that the capital market transactions slow down or are difficult for them to keep going every year with the all the financial alternatives coming out, people going public on their own, right? That could cut into their possible business. So I think that's a little bit of risk, and they know it too. That's why they're pivoting into bank to get more sticky money. But this is my review. Thank you for watching Rational Investing. If you like this type of work, securities analysis, or you want to do it for yourself, check out my website, cashflowinvestingpro.com, where I teach you how to build a stock portfolio of companies with a high probability of beating the market by doing simple work like this and trying to find an underlying case for a stock that is well priced and should beat the market. If you assemble a portfolio of companies that have a higher probability of beating the market, you could probably assume your portfolio as a whole would beat the market. All right, my name is Cameron Stewart. This is Rational Investing. Thank you very much. I hope you liked the review. Please hit the subscribe button, hit the like button, throw a comment down in the comment section to see what would you like to see next. I'm happy to take recommendations. Thank you very much. Bye-bye.